I've kind of deviated. We talked about a lot of different things in the last few shows. We haven't talked about insurance as much. And something that's really been on my mind about insurance is I tell people this all the time. Insurance, the devil is in the details. And I think that's something that's really important to try to help people understand when it comes to insurance. Because most times people think like if I'm buying a homeowner's insurance policy, it's the same for same.
Yeah, no, for sure. I think we've been dealing, I've been in the insurance industry now 14 years or so. And I recently had my first claim for my through insurance. Yeah.
Welcome.
And I realized I need to go read my policy.
You're like, what? There's details in this policy?
Yeah. What is
it's just covered, right?
Right.
Why do I pay all this money?
Yes. I remember I was early on in the claim. I was like, man, I better read how this all, like my policy works. Cause it's easy to home insurance. Okay. Home insurance covers your house. Like, okay, but how and when and to what extent and to what coverages. And so,
yeah, I had a customer that I was doing a review with them on something on I think it was their auto insurance, and they had canceled their home insurance with us and had gone to a different company. And I was like, well, that's part of why your rates went up on your auto insurance is you lost that discount. We should look at that again. And he happened to have brought his homeowner's insurance declarations page with him. And he was like, well, this new policy was like $350 a year less. And I was like, okay, well, let's look at it. And I was like, well, it's less because your coverage is different. Like you have way different coverage than what you had with us. He's like, well, I told him what I had.
Right. Yeah.
And so in his defense, the dwelling coverage, it's called coverage A or dwelling on his policy, showed the same. So the policy that he had with us showed, it was like $420,000. The policy he had with the new company showed $420,000. But then the differences started in he had extended replacement cost, which means if it goes over that $420,000, he would have an additional, and his extended replacement cost was 25%. So he had an additional 25% on top of that $420,000 if he needed it. The policy he had with us was guaranteed replacement cost, which means that there was no limit. Mm-hmm. We would just rebuild the house no matter what the cost was. There was no cap. Right. And so I was like, well, that in and of itself is a huge difference.
Yeah.
If you have a claim, you could be out. You could not have enough money to rebuild your house theoretically on that policy. And that's just going to be the way it is.
Right.
Policy you had with us, we would rebuild your house no matter what the cost was. It could have been $1 million to rebuild because of inflation and who knows what else came up, and we'd still pay that.
Right. Yeah. I think that is the hard part. You brought up the term or homeowner's policy or declaration page, and those numbers. I mean, one, I think if you're not in insurance, that page alone looks overwhelming already.
Right.
There's coverage A, dwelling, this number, deductible, and then it just like line items.
A, B, C, D, E, F. You have all of those lines are coverage items.
Right. And then it starts abbreviating things like, if it's how it's going to be paid out. And it can feel overwhelming. And I think as just consumers of insurance, as long as the numbers match, I'm happy.
Right. That's what we look at. We look at that on you're looking at a homeowner's insurance. You look at coverage A, your dwelling amount. Like, well, that's how much my house is going to be covered for. And I look at my premium. Those are the two things most people pay attention to when they're looking at homeowner's insurance.
Yeah. So the conversation is with customers, and this is what you were doing is, hey, it's good to look at the coverages and the numbers are there. But then, like you mentioned, it's important to know the details of like, well, how do these coverages actually work at the end of the day?
Right.
And not that you have to go through the whole policy with a fine-tooth comb, but to a degree you have to understand.
Right. Well, the thing is like people forget is like the insurance companies are putting that extra 100 pages of your policy, that thick policy that you get, in there for a reason. And people are like, oh, it's like all that matters is those first 2 pages. Like, well, actually, really what matters is that 100 pages behind it. So there's like 6 main types of homeowners insurance that all could show $420,000 for dwelling coverage. Oh. And they're all going to respond differently in the event of a claim. So like you could have, they have HO1, HO2, HO3. They have DP1, DP2, DP3. And then you can have basic, broad, or special form of any of those. You could, so you could mix and match a lot of different combinations, and it's going to change whether it's replacement cost, actual cash value, extended replacement cost, whether it's named perils, whether it's expanded named perils, or if it's an open perils.
Just listening to you, and I'm in insurance, I'm like, that sounds overwhelming.
Right. It is. It totally is.
Just show me the numbers.
Right. Just like, how much am I paying? It's like, well, it depends. Right. And this is the part, right? Like, so I think about this. So I'm going to use the example of a basic form versus a special form. So basic form, you're going to typically is always going to be ACV, actual cash value. So they're going to depreciate the replacement costs. So based on how old it is. And it's going to be named perils. So you get like 10 named perils. You get like fire, theft, lightning, things like that. They don't cover water damage at all. So if you burst pipe, it's not going to be covered.
Yeah.
Whereas a special form is an open perils policy, which means if it's not specifically excluded in the policy, it would be covered.
Right.
So they will cover a burst pipe typically, unless they added a specific exclusion for that burst pipe. And it's going to be covered at replacement cost. So that $420,000 that you have on your declaration page on that basic ACV policy, you have let's just use fire. So it's a covered peril. You have a fire, the house burns down, and the contractor says it's going to cost us $410,000 to rebuild the house. So you're thinking,
yeah, I'm good.
Right. Because I got $420,000. Joke's on you, Andy. I have enough coverage.
Yeah.
And then the adjuster says, okay, the bid is $420,000, but your house is 10 years old. And the life expectancy of a home component. Now this is, you have effective age and you have actual age. The actual age is 10 years old. And we're just for simplicity purposes, we're going to say that's the effective age as well, which means the life expectancy of a house, I think, is like 40 years. So you're 25% through roughly, using some round numbers, through the life expectancy. So they're going to take that $400,000 bid, or that, I said 420.
410.
I said 410, right? Because your coverage was 420.
Right.
So you're going to take 410,000, and I should have used numbers that were easier for me to math. And we're going to say they're going to pay out 75% of it because your depreciation is 25%. So then they're going to say, well, we'll give you a check for $307,000.
Right. But my coverage says 420 on it.
Your limit is 420. Your coverage isn't 420. And that's probably where there's some misunderstanding about how the insurance works, right?
Right.
They look at the limits and think that's what my coverage is.
Right.
That's the maximum amount the insurance company is going to pay. Whereas the coverage is defined inside of the policy.
Right.
So
how are we going to pay the 420?
What am I going to pay out to you, or in what instance will I pay out to you, and how much will I pay out to you?
Right.
So your ACV basic policy, your fire, it's a covered peril, so you're good. Your bid was $410,000. So you're like, I'm golden because I got 420 on my deck page.
Right.
But it's ACV, so they depreciated it and wrote you a check for $307.
Yeah.
On the flip side, that special form, which now has RCV, replacement cost valuation, on the policy. It's open perils, fire is covered, it burns down, the bid comes at 410, you say, I got 420 on my coverage, and the adjuster will write you a check for $410,000 because it's replacement costs. So now that $300 that you saved on your annual premium cost you $100,000, $103,000.
Yeah. Too much.
Right? Like, and that's what I always try to convey to people is to think about is when it comes to insurance, you should insure things you can't afford. Mm-hmm. If you can afford $100,000, you're like, hey, I'm cool. If that cost me $100,000 and I'd rather save that $300 and I figure my return on that investment is good. Well, then fine, buy the ACV policy and know that you're going to be out of pocket in the event of a claim. And that's within your comfort zone.
Right.
For me, like $300 is inside of my comfort zone.
Right.
I can pay that $300. $100,000 is outside my comfort zone. I'm like, I'm not comfortable paying $100,000 if my house burns down. Right. Same thing with liability. I tell people like, you should have liability enough to protect your assets because I'm okay paying $200 or $300 a year for an umbrella policy for an extra $1 million. So if I get sued, I don't lose everything.
Right.
Because I can afford $200-$300. I can't afford to get sued for $1 million.
Right.
That's going to hurt me. That's going to negatively impact my family and our future for a long time if I lose $1 million lawsuit.
Right. Yeah. And that's, and like you mentioned with regards to like coverages versus limits is it can become overwhelming, but the hope is you have an agent that's kind of walking you through this going, here's the limit, the total, here's how this coverage works according to this particular policy. And so here's, are you willing to take that risk? Are you okay with possibly being out $100,000 and some $1,000
right
in case of a fire? But you don't, if you don't understand it and you're just looking at the numbers, all insurance looks the same at that point.
Right.
It's $420,000 that I'm covered for.
We see this on commercial insurance too, right? General liability for a contractor.
Yeah.
$1 million per claim, $2 million per year, pretty standard insurance.
Right. Yep.
So I'm like, hey, if I'm a contractor and I buy that, I'm just fine.
Right. So you think.
Right? There's not a problem if I go like, hey, I build homes, right? So I'm insured as a single family home contractor even. And now I'm building a track home development.
Right.
Well, I'm still just building homes, so I'm fine, right?
Right. Right. Until something happens.
Right. Until you read the policy and then the policy goes, well, actually, there's an exclusion for multifamily and tract home development in here. If you build more than 10 homes in any development at any point in time, we're not covering it.
Right.
Like, but I got $1 million.
Yeah. And that is the part where we often, where we normally see the tension with claims. Sometimes it's the claims process is just hard. You've out a home or whatever, and it gets frustrating. I think sometimes it's when the shock goes, well, that's actually not covered.
Right.
because you are on a named peril, which means it has to be listed as a covered loss in order for it to be covered, and it's not listed. Water damage isn't listed. And so I'm sorry to tell you.
Right. Well, and I've seen that, right?
Yeah.
I've seen that exact scenario that you just described, where the homeowner's coverage amount, dwelling, same amount, separate structures, same amount, loss of use, same amount, which pays for you to stay someplace else where your house is rebuilt. Liability, same amount. Medical payments, same amount. Deductible, same amount. You think you're getting the same policy.
Yeah.
Right? And then they have frozen pipes.
Yeah.
And this policy was even a special form policy, right? So the customer would assume it would be fine because it's an open perils policy. Right. So this is the part that even gets a little more tricky because it's an open perils policy, which means it's covered unless it's excluded. So the customer is like, oh, well, we're fine.
Right.
Except there's an exclusion for all water, including frozen, unless you add this extra endorsement
buy it back
on.
essentially. Yeah.
And then the customer's not covered.
Right.
And you go, and the customer's sitting there very frustrated. Well, I didn't know. Well, it's because the devil's in the details.
Right.